This is the Biz of Wealth. Challenges, rumblings, and evolution of the wealth management industry.
Welcome to A Business of Wealth. On this episode, I had the pleasure of speaking to Leonardo Cardoso, who is the CEO of Quantitatively Systems. He has over 19 years of investment industry experience to help grow the company's retail and institutional fintech solutions. Leonardo has worked at some of Fortune 500 and Wall Street's most recognizable companies and banks, such as Enron, Waste Management Inc., JP Morgan, Citigroup, and most recently at IDB Bank of New York, where he served as the co-manager of a global multi-asset investment strategy. Furthermore, he spent 6 years at NYU's School of Professional Studies teaching what he refers as the art and science of investing. So without much further ado, enjoy this wide-ranging conversation with Leonardo. Okay, Leonardo, thank you for being here. Welcome to the Business of Wealth. It's a pleasure to meet you.
Pleasure is mine. Thanks for having me.
So let's start with, everybody's, catch-up phrase right now. How has the pandemic treated you?
I would say not too bad. Maybe this is a little surprise. I've always been a little bit of a hermit, if you will, right? I like to stay indoors and inside, and so in that case was good. I guess we're trying to keep the sanity with the kids around. So I think that has been the challenge. At the same time, a blessing of having them, healthy close by. So I think that has been the most difficult. It's really try to reconcile, family and work together.
Right.
Now, as far as reaching out clients and talking to people, I think this has been a tremendous push towards the ability to talk to more people. Because, as you know, New York or any other big city would take hours to get to some place, and now we can probably talk to 2 or 3 or 4 different people within one afternoon. So I think in that case,
I've heard many companies and many clients actually do much better in business development. Yeah.
That has been good. That in that case has been good. With the ability to talk to more people without necessarily having to move around. Of course, I guess at the end of the day, deals and everything else will end up being a face-to-face, and it's important. I'm not disregarding the need for human interaction, but at least the first stages of flirting per se, can be done online in a lot more efficient way.
So I've been looking at your company, and you have, basically a sentiment monitoring platform, which I found very attractive. How does it work? Tell me a little bit about it, and what do you think?
Yeah, this company that I'm involved with now, Quantitatively Systems. It's a first of its kind, actually. My background comes from a fundamental analysis, right? So I've looked at in the past, and all my previous employers and everything that I've done was mostly, looking at the fundamentals, some kind of technical analysis, so on and so forth. And Quantgate has a pretty interesting science, which is measuring quantitatively in real time the behavior of market participants. So in other words, think of this as having the ability to see the herd of sheep, right, and having an inference and understanding which direction they are moving. And by that analogy, I'm talking about the market participants in any liquid markets or liquid traded instrument around the world. So it's quite unique. We're looking very forward to deploying this globally. I'm very excited. I haven't seen anything like this before.
Well, in marketing, we always think, and that's why I love marketing. We always think about the psychology of the masses. How do you incorporate that into an algorithm? Actually, how do you do that?
Yeah, it's interesting. I'm glad you asked. But basically, what our tech guys did, basically they were able to measure through the order book, right? So that's where we get the information from. We consume the level 2 quotes in order book for any exchange, any instrument around the world. And we have 4 independent algorithms that measure the perception, right? Which is by itself, an abstract.
Stop you there. What's the input for perception?
The order book for any instruments, right, for any liquid assets around the world, right, the level 2 quotes in that case, which is provided by market participants. So it's you and I and the Fed and mutual funds and all of the market participants are buying and selling. Actually, they're putting their bids and offers, right, into the order book. So we are measuring, we are gathering that information and putting through our 4 algorithms that measures now behavioral traits per se, or abstract concepts. And we are putting that quantitatively in front of the user, in front of the trader through our platforms. So we are doing, as I said, we are measuring perception, everything through the order book. That's the only input that we have, the dynamics of the order book. So we are able to infer what is the perception of market participants, what is the commitment, what are they committed to do, what is the equilibrium, which is a little more quantitative that we can discuss and understand what equilibrium means. And the last one is what's the sentiment of market participants. So out of these 4 algorithms, we have 3 that are very behavior and only behavior related, abstract, right, concepts, and 1 that's a little more quantitative. We put all of that together with the artificial intelligence and machine learning. So now we have a good understanding of the direction of the market and what the market participants are doing based on the order book. Does it make sense?
Yeah, that's super interesting.
Yeah, it's quite a different way of observing. The other thing is, there we go, I forgot to mention, this is real-time analysis. So it doesn't matter what happened 9:30 in the morning. It's not necessarily the same market participants, right? Maybe is a hedge fund that's trading in the morning. Maybe it's an algorithm trader. Maybe is a retail trader that's participating. Now it's lunchtime. It's not the same people that are participating. And now it's 4 o'clock, 3:30 or so, and doesn't necessarily mean that it's the same participant. So we were able to classify, right, with these algorithms, and based on how the dynamics of the order book is being played, we were able to classify and qualify, or classify I think is better, 55 types of market participants, from the most active and let's call it the most active high frequency trader, algorithmic trader that usually have a tendency to drive the markets in short term, to the slow moving types of participants such as the mutual funds and the pension funds and retail traders that don't necessarily react to price, but they're a lot more like price takers.
Long-term strategies.
And long-term players. So you see, if you have a chance to take a look at our platform. The other thing is we have no lines. We don't talk about technical analysis. We have nothing that resembles technical analysis.
Right.
There's no such thing as supports, resistance, Bollinger Bands, moving averages, none of the technical indicators that 99.9% of the traders probably use. And this is a very fresh approach visually and conceptually to infer direction, short-term direction in the market. One of the contributors, I guess the biggest contributors to the platform besides the technology, it's a fighter jet player, an ex-fighter jet pilot that was saying that, listen, as they are building the user interface, they said, well, when I'm flying my jet, I don't have the ability to analyze anything. I have to react to what I see. Right. If I am analyzing something to make a decision, I will most likely get shot if it's in a firefight, right? So the decisions are made in a split second. Therefore, I have to rely on my visual cues to decide to go up, down, turn left or right. And that's basically what got into the platform, was the ability for traders to use visual cues and colors and shapes to make a decision to either buy, sell, short, go long, or trim, or whatever your strategy that you're doing. So basically, we're enhancing human capabilities by giving this extra understanding of another dimension of the market that no one is giving that, right? Which is the behavior what is the behavior of market participants in real time.
What's the trend? Yeah.
So this is really, really unique, and
So
we're excited
you were mentioning this. You mentioned Target. I'm sorry. You were mentioning traders. Who do you think are the best ones right now after the pandemic? Everybody's talking about active strategies because the passive strategies of the last 10 years are not going to work anymore. So who are the best traders? What do they do differently?
Sure. What I found, the best traders are those who understand, right? First of all, themselves. This is the same story for decades and ages.
Psychology of
themselves. I think since the trading has began. So if you understand themselves, they are ahead of the pack. They also need to understand the playing field that they're playing, right? The rules of the playing field that they are trading. And the third thing that I look at it that separate a lot of traders from each other is you have to be playing in your comfort zone. If you are in your comfort zone, if you found that comfort place, then you have a tendency to don't push the envelope too hard, right? So you know what you're doing, how much heat you can get, and avoid the typical mistakes that we are all susceptible for based on our cognitive dissonance and emotional bias. That it's what I like to say are undisputable shortcomings of human beings, right? Not only human beings, but also machines sometimes, right? If you think about it, the machines are being programmed. They are being not only programmed, but they are learning from each other within the artificial intelligence and machine learning environment. There is some, I believe there is some bias inherited into the way you learn, right? So that's how humans learn. It's based on experience and how the information is passed through over time and experience. And I think machines are the same. Machines, as they are learning from each other, as they are learning from the environment, what's happening that helps them build this knowledge base is creating a bias into how they will react a week from now, 10 years from now, whatever is the time frame, where they have to recollect that lesson learned and act upon. And
let me stop you there. How can you make quote unquote subjective exceptions? So let's say machines are learning from the drop in the beginning of the pandemic, and then they go back, and are they expecting another drop? Like, what do they learn from there, from that moment, and how do you input other subjective factors or factors that are not into this algorithm? Like, how do you incorporate it all?
I think part of that question would be better so by my tech guy, my CTO guy. However, I'm going to give you my common sense, right? And I believe, I truly believe the investments in trading, it's probably, I don't want to undermine anybody else's ability to do or level of understanding and intelligence, but I think common sense goes a long ways in a lot of things, right? And if it makes sense, we are on the right track. So common sense for me, when I look at this and what I just told you about what I believe machines also have a bias, is because we are assuming that they are operating like human beings, right? So and I'm going back and I say, okay, so how do the human beings learn and how do they react based on situations? And therefore, I'm making this kind of leap into, well, the machines also have the same problems that we do, right? They have to act and react. They have to analyze information the same way that we do. Sure, much faster, no question about, much faster with a lot more information, but they still have to absorb all the data and come up, all the inputs and come out with an output. I think that's true for humans and machines. But in our case, what's interesting is that we are not necessarily relying on what's happening in the past to to allow our algorithms to give you a signal or a direction, because everything is measured in real time. As I said, it doesn't matter who was trading yesterday in the market. Maybe, I don't know, maybe a big hedge fund, right, that has the ability to drive markets in short term is trading yesterday and is pushing, right, the market one way or the other. Today is every second is a brand new second, and every time it's not necessarily the same market participants with the same interests and the same behavior. What we are doing, however, we are looking at how these participants, from humans to machines, are placing their buy and sell orders and inferring based on that reaction or that dynamics, right? Based on that interaction among themselves, and inferring what is the collective behavior of all the participants is telling us, right? What I like to use the following analogy. There are many different analogies that I heard about this, and I'm sticking to this one because it kind of made sense to me, and I believe I was successful in doing. Think of this as we are flying a drone inside of a herd of sheep, right? Right in the middle of a herd with, 200, 300 sheep. And at the eye level, if the drone is flying exactly at the eye level for that sheep, from all those sheep, I don't really have a sense, and I don't really know what the sheep's at the edge of that herd, which direction they're moving, right? Because I can't see other than 2 or 3 sheep away from where I'm standing.
And you also don't know how many sheep are.
Correct. I don't necessarily know how many are in this herd, but so this is kind of, I have a limited ability to infer which direction the sheep, the herd as a group is moving. Now, if I take this drone and I fly at 30,000 feet and look at it from the above, and I can say, well, as a herd moving, I can do 4 things, as the algorithm says. What is the perception of the herd in relation to the right direction? What is the group is doing? Are they moving to the left? Are they moving to the right? What is the perception? What is the commitment of the herd? Because once there is a certain perception which direction the herd's moving, then there is a point where the herd, I believe, is committed to going in that direction. Maybe there will be stragglers, right, going in that direction, one or the other. But once the herd's moving, right, then everybody else is moving in that direction. What is the equilibrium from the herd? So think about this way. If there's more sheep going to the right than to the left, that's the equilibrium, and there's a bigger chance that the herd is moving to the right. And finally, what's the sentiment of the herd as a group? Which is I guess is the nail in the coffin that says, well, as a group, there is a sentiment, and I would love to quote my tech, right, our CTO, to be able to explain to you in technical terms the sentiment mathematically. How do we represent mathematically the sentiment, right? Because it is an abstract.
An abstract concept and a very subjective one,
right? Between 2 different people, we might have 2 different definitions of sentiment. So I think the merits to all the technologies to really having the ability to measure all of this mathematically and give it visually, that information for the trader to then decide, either as a support to whatever he's doing or her, right, whatever they're doing, or simply as the fighter jet pilot said, or simply react to the shapes and colors that you see and then taking a position. So it's obviously a short-term strategy, trading strategy, which we can package that into a hedge fund for investment purposes. But in its essence, I see it as a short-term trading enhancement to whatever traders are doing. And naturally, the traders are naturally short-term oriented.
Naturally, yeah. So we were talking just before we started here, and in terms of the challenges of launching a new company like this one, and also of communicating such complicated concepts. Tell me a little bit about it. How has
I think that you said it right there, right? The challenge to come, well, first of all, is the challenge of new, right? Versus the proven versus unproven, or the new. The second thing is, from what I've been exposed, is that until the recent past, technology in itself, we had some constraints in terms of the technology available for us to be able to deploy it safely, the technology. So in relation to infrastructure, networks, so on and so forth. Obviously, there's a tremendous amount of intellectual capital put into the development of this technology. So we don't want to risk it having been hacked or being used differently than what we wanted. So that was one. And like, as I said, the new, right, the new quote unquote unproven, even though I said unproven, but we've been through some trading auditing that has been done in our portfolios. KPMG audited the results for 3 years, and we had a tremendous that we were achieved by deploying the technology to a trading strategy. So basically, if you think about it, our technology has the ability to enhance any investment trading strategy out there, because I'm giving the ability for traders to understand better the direction of the market.
To go with the market. Obviously,
Correct.
this is targeted for short, for day traders, not for
I would say, yeah, between the day traders and the swings, any kind of short-term market movements, because by itself also, I don't have the ability to measure behavior for next year, right? It's in itself, it's a hard concept to be. It would be. It doesn't make common sense.
Trying to predict the future, and that's exactly what.
Correct, right? I can predict the immediate future.
Will tell you not to do.
Yeah, well, but the immediate future is much easier to predict, right? The immediate future. Then, how will market participants feel? What is the behavior, and what is their sentiment by the end of this day? Example, it's kind of easier to have that infer. Then, how will market participants feel next year during summertime? I mean, it's
right now
I think
impossible.
So for that, I think fundamental analysis play a much bigger role, personally, professionally, than behavior. So that's why we're kind of sticking.
So right now, what's the greatest challenge for you with clients? Then where do you see your
in the technology itself? I think it's from the challenge that we have right now is really deploying the technology, right? Is a global, what we are trying to do is a global deployment of our technology simultaneously, let's say it that way, into different places, US, South America, Asia, so on and so forth. The marketing, the proper marketing of what we have is going to be the key, because I believe we have a great product and a great story. Is properly saying that at the right channels, at the right, for the right audience. So it's being in front of people and correct. And for that also, it demands there's a cost, right? Not only capital cost, but a human cost. There's a couple of challenges, such as well, if all of a sudden we have a big influx, as we expect to have, of downloads, right? We have to service these accounts, right? We have to provide support. In the past, that was one of the issues that we faced, was the ability to provide support. We don't want to make kind of the same mistakes.
That's key, having it's not only getting to the client with the target, with the right message at the right time through the right channel.
Sure.
But also once they on board, it's even more key to be able to give them the right experience.
Yes. And we are not want to correct.
Every single stat in the world will tell you that client service customers, doesn't matter if you're B2B, B2C, whatever
Mm-hmm.
industry you're in, they will expect you to be swift and fast and get somebody on the phone for them
Mm-hmm.
or
Yes,
on
I agree. And that's why we're kind of threading this moment before the everything is ready, right? We have the app available to be downloaded in the App Store, right? The whole thing is ready to be consumed. And now we want to make sure I was hitting the app, now we want to make sure that we have also the ability to support the demand that we are expecting. The app in itself, I think it's fairly priced. I think we are about to hit. We are in a market where there's millions of people interested, especially nowadays with the pandemic. I mean, trading became. I'm Brazilian, right? So Brazil, the most recent cover page of a magazine seems like cocaine, but it's day trading. Because it's getting addicted. And I'm gonna exactly translate. Yes.
It's a new hobby, right? It's like everybody thinks they can be a day trader.
A day trader, exactly.
It's like when with the real estate bubble, everybody thought they could be a real.
Everybody thought they can be a real estate, correct?
Or a real estate investor. Now everybody thinks they can be a trader. What's up with that?
There we go. I got it here, and exactly. It looks like cocaine.
Yeah.
But it's. I don't know if you can see. It looks like cocaine.
Yeah, it looks like cocaine, but it's day trading.
And Robinhood is helping, right? Not to take away the benefit that they're bringing to the market, democratization, zero commissions, so on and so forth. I think we are really in a. I think the main problem is intellectual capital, and that has been the problem forever, right? It's not access necessarily because.
Well, it used to be very expensive and only for elite. The problem is that the reason why the regulations are there in which they protect the investor, because you're investing in things you do not understand. So the risk for you to lose all the money. So there is a reason. Maybe we are over-regulated, that I may agree on. But I don't think the regulations are out of the question. You cannot, it's like selling, I don't know. There are certain things that you cocaine. There are certain things that you have to protect the public from, and from misleading advertising
from bad participants. Yeah, the Elon, our CTO, says he told me one thing that I loved. It's free trading is not risk free.
Exactly.
Right, and everyone thought free trading is about risk free. Right, and granted, in where we are today, with markets going up one direction only after this huge downside that we had, right? This huge hiccup that we had. Now more than ever, people are thinking, well, that's really easy to make money.
Oh yeah, like I should have bought. If you had bought in March, I would have won. But you're not taking again your psychology into account.
Correct.
And your psychology will always deceive you. That's what you said. The best traders are the ones that understand themselves. If you don't understand your psychology about money, you're not going.
Then that's it. Yep, you're correct. That's exactly right. And that's one of the fears. Now, from a trader perspective, now the other challenges from a general investing population, not only trading, is the fear of missing out. Right? They're seeing Tesla tripling. They're seeing Apple. They're seeing Amazon. They're seeing all these companies like spiking and doubling, and all of a sudden everyone is falling behind. I think this is danger, because everyone is chasing this market performance, and at one point in time, if you are lucky enough to pass on that baton to somebody else, so you're not holding that hot potato, that's good for you. But I believe that you will fail 8 out of 10 times if you keep doing this. So maybe it's working now. Maybe you get a chance, and you turn your $100,000 into 700,000 or 800,000. That's great. That makes a difference. You bought 100% Tesla stock, and you're up that much. But if you do this 10 times,
you never get out in time. And if you did it once, you're not going to do it consistently.
And I think that's the story that we never hear, right?
I know it is old school, but that's what Buffett always says. Like, don't target, because you're not like.
Yeah.
You're not gonna win. It's like playing the casino.
No one tells you about that loss. They all tells you about that gain. And you, I mean, I've been doing this for 23 years now professionally, not trading, but investing and trading and everything else for large institutions. And I saw a very cool tweet the other day is the worst feeling ever as a professional, right? When you see kids and young people that are not young people but new to the market beating all the professionals and everybody else, it's a terrible feeling. Makes me feel bad. I was like, what's wrong with me? What I don't know? Well, I guess the story there is that I really do know about the risk. And when you really are aware of the risk, you play differently than if you don't know the risk. So the moral of the story is that the people that are playing this game right now that started recently in not only right after the pandemic, but also in 2019 when the market went up, right?
Oh,
recently,
yeah.
the market has been going up tremendously for many different reasons. And it's one direction only. So when it's one direction only, you can't really lose unless you're not playing, you're on the sidelines. And I think for the professionals, that has been hurting, not participating as much because they understand how much risk is involved. Right
so
now.
if now that you mentioned the young ones, if you had a nephew or I don't know, a cousin or somebody starting now their careers in portfolio management, what would you advise them to do?
One of the things that I've always I was lucky to know what I wanted to do from a very young age. So everything that I've done has been towards a one direction. So which is managing, investing, and trading and participating in the stock market. So I found that out at a exchange student experience when I was 18 years old, which is a long time ago, and I've been doing only that. Everything that I've done, every single effort that I took, was towards to be in the position that I'm in today. I would say that I have honed my skills. I have focused all my energy in that single direction, which is investments related and portfolio management, trading, so on and so forth. So for people that are starting today, I would say, like I said, an AFO is really understand which direction you want it to go, and if it's really you want to be in a position to make investment decisions that ends on you, or if you are a big part of that decision-making process, be it because of your experience or be it because of your intelligence, that you are a programmer, that you made a code, right? Focus, understand that, decide if that's what you really want to make investment decision. Because one thing is, let me take a step back and say portfolio management, it's a word used kind of sometimes thrown out there without really understanding the meaning, right? So if you, in other words, not many people have the ability to make trading decisions and investment decisions that are outside of the norms of your employer, put it that way, right? So if you're working for one of the big banks or whatever, you are a portfolio manager on the title, but are you really managing that money, or you're simply following, the directions of whatever body
that's not
that you are exactly. So for those who are moving into the direction, is really understand: do you want to make an investment decision? Do you want to be responsible for it? Because there's the consequences to it, right? You live by the sword, you die by the sword. I used to say when I was in corporate. Yeah, when I was in corporate, I used to say, I don't mind putting my head on the chopping block and really being guilty party to the decision. And that's what it takes, right? Not everyone is comfortable with that level of responsibility as well, or that level of risk to your image, right? Or to your professional risk. I understood that, and I was, and I'm still, working towards that I'm still in that same path, working towards being the person or involved in a big way on the decision-making process, on the investment decision-making process. So I would say to the young one is really understand what you're getting into it and work hard for it. It's not that hard. It's just have to work hard for it.
That's good.
Because it's not easy. It's definitely not easy to make that decision. Right when everybody's right, there's no questions about it. Right? You found the right location. You're making money. Clients are not calling you. Nobody's calling you to praise you.
Is calm is because there is something like.
But when there is something wrong, you will get that call and find out there's nothing wrong in being wrong. There is wrong in not knowing why you were wrong. That's what I believe, right? And of course, with your money, with your personal money, you can be much more wrong. With clients' money, and that's when professional risk comes into play. Is with clients' money. How much can you be wrong? And I'll go to the scene.
Psychology. How much can you stand to be wrong?
How much can you stand to be wrong? Yeah, I'll go to that scene.
In front of the client, right?
Correct. That's different with your money, right? So you can stand wrong. Go to that scene back on that movie. What is it? The movie about the financial crisis with Dr. Burry. I forget the title right now. Where I think it's Christian Bale. The actor, right? He's playing the role of Dr. Michael Burry, and he's almost bankrupt when he's batting against the housing market.
Oh, right. Yes.
What's the name of the movie?
Yeah.
The biggest loser.
The
big bet.
The biggest. Oh, but
not margin call. I always forget. But anyways, you know what you're talking about. I hope
the biggest. I'm gonna look at it. Give me a second.
It's something like this where he's bad and he actually had to block investors from cashing in the fund. He was wrong for 3 years or so. I can't remember exactly.
A long time.
The Biggest Loser? No, I think it's The Biggest Loser. No, The Lost? No, not The Biggest Loser. So sorry. I didn't mean to. But that's a great scene that shows his conviction, right? And even if he's right, the guy is a genius. He's right.
The Big Short.
Thank you. Yes, The Big Short. The guy's a genius. I mean, he's an amazing guy, and he's wrong.
He was able to withstand it. Like 3 years. It's
barely, right?
Long time. In
correct.
Fact, he has a psychological resilience that 99.99% of
won't be able to. Yeah, clients will probably bail out already. Clients will take the money and withdraw the funds. They did exactly. Yeah, they sued him. He blocked. But that's a great example of what we were saying. It's you understand what you're doing and you live and die by the sword and your conviction. And it's not easy to be in that position, right? Be God or be, the devil.
Yeah.
It's one or the other. It's a great intellectual challenge. It's a great emotional challenge to be able to find yourself right or wrong. And it's a learning experience from every time that, you learn about yourself.
Well, that's a perfect circle to finish our interview because we started with the learning of, the learning experiences of people and machines. Mm-hmm, and we finished with, being wrong in trading, but learning from it. That's the biggest key, right?
Yep. I think you're right. The full circle is understanding, well, there's the inability. Well, one thing that you mentioned. What is the biggest? What is the true thing that nobody believes?
What is something true that almost nobody agrees?
No one believes. No one really knows what's going to happen, right? It doesn't matter how big you are. I guess the only person today that can claim something is Jim Simmons, right, from Renaissance. He definitely is in a league of his own. And I'll give it to Warren Buffett and all his disciples and everything else. But not to take the merit of any sort for him, but it's easy to be a buy and hold long-term investor. It's much easier because you buy and hold and forget it, assuming that you have the ability to withstand that drawdown.
You don't need the money in that drawdown.
You don't need the money. You are in your comfort zone. You don't need to pay bills, right? So it's kind of always have firepower, have dry powder, buy low, sell high. Yeah, but if the market's going down, I don't know about you and everybody else, but my capital is limited, right? I don't have the ability to be buying low forever.
Yeah.
However, a guy like Warren Buffett and everybody else, they do have that ability to do so. And in the millions and millions of dollars, so they don't have to worry about, right, running out of money. But for the average person, that's not really applicable. As the other day, the guy said, the Rothschild, I think, says, you buy when the cannons are sounding or something, when there's problem. Yeah, but at one point in time, you can't buy it anymore, right? If it continues to go down, it gets a point that you are tied out. So I guess learning from that, it's important, and really understand that nobody really knows where the bottom will be or where the top is. And that's why I said Renaissance from Jim Simmons is probably the guy today that has been able to figure that out in this short history or in the recent past, because his performance has been stellar, as we heard, as we know, in the recent book that has been published, the guy who solved the market. But outside of that, I think anyone from the large, institutions employing hundreds and thousands of people with the PhDs and the CFAs and all of the technology power is the inability for everybody to understand what's going to happen, right, in the future, the expectations of the future. So especially as you go farther and farther away. So I'll circle back to, that's why I like our platform and our technologies, because we're not necessarily looking too far ahead. I just want to know, right, what's going to happen tomorrow and the week after in terms of trading, right, to apply my technology. So I'm happy of deploying and understanding what's the behavior of market participants in short term to be able to make my trades. And for investing, buy and hold. If your horizon is long enough, as institutions are,
good to go.
You're fine. All right.
This was an amazing talk. Thank you so much, Leonardo.
Thank you so much for having me, and looking forward to.
I hope to be in touch soon.
Definitely. Thank you so much.